Hey everyone, welcome to Rock Daily Talks, where we break down the essentials of building and protecting your wealth. Today, we're tackling the topic that's critical to any successful investment strategy: diversification. Diversification is often called the only free lunch in investing, and for good reason. It's one of the best ways to protect your wealth while still capturing growth. So, let's dive into the ultimate guide of diversification and how you can use it to safeguard your financial future. Now, you've probably heard the saying, don't put all your eggs in one basket. That's essentially what diversification is all about: spreading your investments across different assets to reduce risk. But how do you do it effectively? What should you diversify into? And why is it so important? Stick around because we're covering that and more. So what exactly is diversification? In simple terms, diversification is the practice of spreading your investments across different assets to reduce your overall risk. The idea is that by holding a variety of assets, you're less exposed to the potential downturn of any single investment. If one asset underperforms, others in your portfolio can balance it out. Let's break that down further. Imagine you're investing entirely in one stock, Tesla, say a tech company. If that company hits a rough patch, your entire portfolio could take a hit. But if you're diversified across multiple sectors, tech, healthcare, finance, and so on, then a downturn in one area is less likely to derail your entire investment strategy. For example, in my early days of investing, I was heavily invested in tech stocks, particularly Tesla. While that worked out well during the boom, I quickly realized how vulnerable my portfolio was in that sector-specific area, and it didn't feel very good. It really didn't. So, by diversifying into other sectors and asset classes, I was able to build a more resilient portfolio that can weather different market conditions. And when I saw a drop in Tesla, which happens all the time, I would just look to my other stocks and be like, not going to really worry about that. And over the long term, I have done well because it does, for the most part, go up through that volatility cycle. Diversification matters because it helps manage risk. No matter how much research you do, there's always a level of uncertainty in investing. The market can be unpredictable, and even the most solid investments can underperform at times. Diversification is your safety net. It helps you protect your portfolio from the inevitable ups and downs of the market. By diversifying, it's not just about reducing risk, it's also about optimizing returns. By spreading your investments across different asset classes, you can capture growth from multiple sources, increasing the likelihood of achieving your financial goals. Think of a diversification like insurance. Just as you wouldn't drive without car insurance, or own a home without homeowners insurance, you shouldn't invest without diversifying. It's about protecting your hard-earned money while giving it the opportunity to grow. So, how do you diversify effectively? The first step is to understand the different asset classes available to you. These include stock, bonds, real estate, and commodities, among others. Each asset class has its own risk and return profile, and they often move in different directions depending on the economic conditions. A well-diversified portfolio typically includes a mix of these asset classes. This is just an example. You might have 60% in stocks, 30% in bonds, and 10% in real estate. This mix can help balance the high risk of stocks with the more stable returns of bonds. And this percentage can even change depending on your age and your particular goals and when you need your funds. Let's say you're a moderate risk investor. You might allocate your portfolio like this: 40% in large cap US stocks, 20% in international stocks, 20% in bonds, 10% in real estate, 10% in cash or cash equivalents. This spread gives you exposure to different markets and sectors, helping to smooth out the bumps in the road. Diversification isn't just about spreading your money across different asset classes. It's about diversifying within each class. For example, within your stock allocation, you might diversify by investing in different sectors like technology, healthcare, and consumer goods. You can also diversify geographically by investing both in the US and international stocks. Let's talk about the sector diversification. By investing in different sectors, you reduce the impact that a downturn in any one sector can have on your portfolio. For instance, if the tech sector takes a hit, Your investments in healthcare or consumer goods might offset those losses. In my portfolio, I make sure to diversify my stock holdings by including sectors that tend to perform differently under various economic conditions. This way, I'm not overly reliant on one area of the market and I have a better chance of capturing growth across the board. International diversification is another key component of a well-rounded portfolio. Investing in international stocks gives you exposure to markets outside of the US, which can help reduce risk and provide opportunities for growth that aren't tied to the US economy. For example, emerging markets often have higher growth potential, though they can be more volatile. Developed markets like those in Europe or Japan provide stability and diversification away from the US-centric risks. When you diversify internationally, you're also spreading your risk across different currencies and economic systems. This can be particularly benefit during the times when the US dollar is strong or weak, as your international investments may perform differently based on the currency fluctuations. Beyond the traditional asset classes like stocks and bonds, there are alternative investments that can add another layer of diversification to your portfolio. These include real estate, commodities like gold and oil, and even cryptocurrencies. Alternative assets can move differently than stocks and bonds, which can make them valuable additions to a diversified portfolio. For example, gold is often seen as a safe haven during times of economic uncertainty, while real estate can provide steady income through rental properties. Let's break this down. If you're concerned about inflation, commodities like gold can help hedge against rising prices. If you're looking for income, real estate can provide cash flow through rent. And while cryptocurrencies are highly volatile, they can offer higher growth potential if you're willing to take on more risk. One important aspect of diversification that often gets overlooked is rebalancing. Over time, some of your investments will grow faster than others, which can throw your asset allocation out of balance. Rebalancing is a process of adjusting your portfolio back to its original allocation to maintain your desired level of risk. For example, if your stocks have performed well and now make up 70% of your portfolio instead of the original 60%, you might sell some stocks and reinvest in bonds or another asset to bring your allocation back in line. I make it a habit to review my portfolio and rebalance at least once a year. This helps me stay on track with my investment goals and ensures I'm not taking on more risk than I'm comfortable with. While diversification is a powerful tool, there are common mistakes to avoid. One is over-diversification, where you spread your investments too thinly across too many assets. This can dilute your returns and make it harder to manage your portfolio effectively. Another mistake is under-diversification, where you don't diversify enough and end up with a portfolio that's too heavily weighted in one asset or sector. The key is to find the right balance that aligns with your risk tolerance and your financial goals. Think of diversification as a balancing act. Too much of it can make your portfolio unwieldy and dilute your potential gains. Too little, and you're taking unnecessary risk. The goal is to strike the right balance, ensuring that your portfolio is both resilient and capable of growth. So, to sum it up, diversification is one of the most important strategies you can use to protect your wealth and achieve long-term financial success. By spreading your investments across different asset classes, sectors, and geographies, you reduce your risk and increase your chances of capturing growth in various markets. Remember, the key to successful diversification is balance. It's all about finding the right mix of assets that align with your goals and risk tolerance. Whether you're just starting out or you're looking to optimize your portfolio, diversification should be at the heart of your investment strategy. Thanks for watching, guys. And guys, if you guys are interested in some free stocks or checking out some investments, click on the description of this video. I have some affiliate links where at no extra cost to you, if you sign up, you get some stocks, I get some stocks, or whatever bonus is being offered. It's a win-win for both of us. It helps support this channel, and thank you.